Welcome everybody to this live streamed MNI Connect video conference. I'm Kevin Woodfield, responsible for MNI events, and it is my pleasure to warmly welcome Catherine Mann, external member of the Bank of England Monetary Policy Committee. Catherine very kindly joins us today to discuss monetary policy in the global context, which could scarcely be more topical. Certainly, Catherine, I'm going to describe you as the epitome of an international economist. Is someone who could be no better placed to address our subject. She worked in the Bush administration's Council of Economic Advisors, dealing with issues such as European Monetary Union, while her time as a Fed economist was chiefly in its international finance division. She was chief economist and G20 deputy at the OECD, and before joining the MPC in 2018, almost to complete the set, she was global chief economist at Citibank. With her name on 7 books, her academic work has focused on the nexus of globalization, inequality, and productivity, including US and global trade, the US dollar, and exchange rate factors, all of which expertise she's bringing to bear on our little local set of challenges here in the UK. And indeed, the MPC has been trying to disentangle domestic and global inflationary pressures. Meanwhile, sterling has been hit by a mix of widening interest rate differentials, with the Fed hiking more aggressively, and the projected relative weakness of UK growth. So how does the committee steer a monetary path through the confusion that helps to deliver us to the other side at least cost to the economy? So thank you, Catherine, for joining us at this really extremely challenging time. Catherine will give a speech lasting some 30 minutes or so, and she'll point to some slides to illustrate her remarks, which will be kindly operated by her colleague, Leonard Brandt. We'll then move to questions and exchanges with our panelists, who can raise a virtual hand to attract my attention, and I can then bring you in. I ask, when you're not talking, please mute your microphones to minimize background noise. This event is being live streamed to a much wider audience who are listening in, and welcome to you all. And everything we discuss here is public and on the record. So thank you everybody for your attention. Catherine, thank you very much again. So how does the global context impact policy setting? We are all ears.
Well, thank you very much, Kevin. It's a real great opportunity for me to join this panel of 20 market participants, and they play a very important role in this transmission of monetary policy to the UK economy. I am not only interested in, the questions you're going to ask me, but Kevin has given me the right to ask you some questions. So I hope we have more of a dialogue after the speeches sets out kind of my views on UK monetary policy in the context of global spillovers. So if Leonard, my colleague Leonard, could put up the screens. Whoops, I have to get my speech back. There we go. We can get ready to go. All right. Monetary policymakers around the world are facing difficult trade-offs. Strong inflationary pressures, even as demand slows. Nuances in their strategies are based on the degree to which the preponderance of the inflationary pressures emanate from external or domestic sources, although by now, domestic pressures are evident almost everywhere. Similarly, there are strategy distinctions depending on how much demand is slowing, relating to initial conditions pre-COVID, fiscal responses during COVID, and as it recedes, as well as associated gaps between production, employment, and expenditure measures of activity. Each central bank is evaluating its policy decision and policy direction as appropriate for their own economies based on the assessment of domestic indicators. In other words, everybody's doing the data-driven decision-making talking. However, amongst the data and relationships important for central bank decision makers is the global financial factor, that is financial spillovers from one economy to another. That's precipitated by different policy paths as channeled through interest rates, asset prices, and the foreign exchange rate. In the current context, with a number of central banks embarking on tightening paths, but to different degrees, the global factor may be particularly relevant. A priori, it's ambiguous as to how domestic policy should react to higher policy rates abroad. Raise policy rates commensurate with the foreign tightening path to contain the currency depreciation, but at an additional cost to activity in the near term, or undertake a more modest or gradual rate increase to moderate the impact on activity, but at the cost of more currency depreciation and inflation in the near term. When we look at the historical data, research finds that the UK, open and with substantial cross-border financial flows, is particularly exposed to these spillovers. Considering the ambiguity in appropriate policy that I just outlined, an evaluation of historical data for the UK reveals that in past experience, the Bank of England has raised interest rates only modestly in the face of the global factor, which prioritizes medium-term activity at the cost of inflation in the near term. A quick question is whether the historical reaction function is appropriate for today's economic situation, where inflation is projected to hit double digits. To consider alternatives, I will show two stylized scenarios for policy paths that differ from the historical response. One takes an activist path and is willing to reverse rates. One follows a more gradual path and is more averse to rate reversals. These have differing outcomes for inflation in the near term, price stability over the horizon, output in the medium term, and volatility in currency markets. Now, of course, these are very stylized scenarios and in no way represent MPC thinking. But along with other data, research, and projections, they did inform my policy decision to vote for an increase of bank rate of 50 basis points at the last meeting. In the current context, with historic inflation rates already evident, and with a large central bank, at least one, pursuing a robust tightening, the UK's exposure and sensitivity to global financial spillovers could exacerbate the inflation activity trade-off currently facing the Bank of England. In my view, a robust policy move based on both my assessment of the domestic conjuncture, which I'll talk about near the end, and being attuned to the global factor, so the two things together, reduces the risk that domestic inflation already embedded is further boosted by inflation imported via a sterling depreciation. Now, before evaluating the global spillovers, it's useful to take stock of where we are and how we got here. So if we move to chart one, we'll see the dominant feature of both domestic and global economic landscapes is, of course, inflation rates in advanced economies that we haven't observed in decades. We know the story here. A sequence of global shocks has let prices rise at historical rates. We had COVID, we had fiscal, we had goods market rotation, supply bottlenecks, and all of that leads to surging prices for goods. Then there's reopening, but at different paces. There's China's zero COVID strategy. And of course, there's Russian invasion of Ukraine. So we know that those collection is a key underpinning of the inflation rates that we see now. Now, these global shocks affect economies differentially on account of their initial conditions, which had to do with the strength of demand, the characteristics of the labor markets, how much savings was available, as well as exposure to the shocks themselves, as well as finally the domestic institutional characteristics, for example, Brexit and the Ofgem mechanism, which are particularly important in the UK context. Now, in the end, the composition of domestic inflation facing central banks including, for example, the Fed, the ECB, and the Bank of England, that composition of domestic inflation has unique characteristics. But for all of these three, inflation rates are far above their respective targets, as you can see from the chart. Now, underneath the headline numbers, there's some nuance having to do with exposure to gas and energy. US inflation has been driven by domestic demand and capacity. Importantly, for the UK, goods price inflation is much stronger than that in the US or the Euro area. Global shocks that I outlined have to a greater or lesser degree become embedded via second round effects in domestic inflation. And in that context of embeddedness requires a monetary policy response. But of course, inflation is just one side of the trade-off. The evolution of activity is the other. So moving to chart 2, we can look at a picture of where we are on that. On the three economies that are shown here, all of them are projected to slow, although there are conjunctural differences across the countries, as well as there are possible differences in fiscal actions that are perhaps going to be relevant in the forecast going forward. US output is nearly back to its pre-COVID trend on the back of strong fiscal stimulus in 2021, and consumption of goods, which has remained well above the patterns of a prior decade. The Euro area had less strong recovery because of coming out of COVID, and of course is more exposed to the consequences of war in Ukraine, but it also has reached its pre-COVID level of GDP. The UK has regained pre-COVID activity in GDP terms, but of course not when it comes to employment, and its GDP is well below trend. Now, given the persistent supply shocks to everyone, but also to the UK, pre-COVID trends may not be attainable. For the three economic areas, the contrast between the output and inflation trajectories illustrate how significant the supply side impact of the global shocks has been. Even so, the balance of inflation rising versus activity slowing differs among these three economies. Therefore, the policy appropriate to meet the central bank's objective also will differ, and that raises the topic of the global factor and spillovers. So I'd like to talk now about kind of where the monetary policy reactions have been so far. The consequence of global shocks and domestic second round effects have required monetary policy pivots. In 2021, most central banks in advanced economies did not remove accommodation because they were concerned about the fragility of the recovery, below trend growth, and weak employment. Further, at that time, the bout of inflation was predicted to be short-lived and mainly driven by a one-off increase in goods and energy prices. However, of course, we've had sequential and subsequent shocks, persistently strong goods imbalances, and of course, global inflationary pressures intensifying, as have concerns that inflation was becoming embedded in medium-term expectations and future price setting. This would put us in a situation where inflation would not be consistent with the target. Of course, this is where the pivot comes in. Central banks have shifted to removing accommodation via their policy rate and in some cases balance sheet. The Bank of England was the first major central bank to move in December after the conclusion of the bank's asset purchase program, which I voted to end early. Now, another set of central banks, of course, have moved as well. Now, if we move to chart 3, what we can see is what markets are pricing in terms of significant action going further. Markets are, as I say, pricing significant further tightening despite a darkening outlook. Traders' expectations of the policy paths, which are the highest for the US in red, UK is there in blue, and the Euro area is in yellow, and the difference between the solid and the dotted lines are different time periods of the observation of this instantaneous forward curve. So traders' expectations of the policy paths, particularly for the US and the UK, is one of near-term tightening to contain inflation, but then backing off as demand slows. The medium-term resting point, the 5-year nominal, is somewhat below the peak in policy rates. Now, the pace of tightening in the near term and how much policy might need to reverse differs according to how the markets are assessing the starkness of the inflation activity trade-off, and in particular, their assessment of second round effects of the global shocks on domestic pressures on inflation. Now for the UK, which is the blue line in the middle, traders' expectations have shifted up and steepened to reflect the MPC's challenge of managing the inflation output trade-off. This is the narrow path outlined by my governor, Andrew Bailey, recent speech. While the MPC sets policy according to domestic macroeconomic conditions, as a so-called small open economy, the UK does not exist in a vacuum. Global supply and value chains, of course, and also global financial markets will transmit what happens abroad into the UK. The MPC takes these international spillovers into account when setting domestic policy. Have these spillovers become more important? Certainly they have been for global goods, but apparently also for the global financial factor. So if we move to the next chart, we can look at some observations on the importance of the global financial factor. For the UK, data and surveys already show a rising importance of global spillovers for domestic financial conditions. On the left-hand panel, the difference between the red bars, the red portion of the bars and the blue portion of the bars shows that the international factors have played an important role in driving market rates, the 10-year change in the UK 10-year gilt yields, as seen through the lens of the so-called Rigabon decomposition. This is based on research on how to decompose the rates into these two components. Furthermore, as shown on the right-hand side of the panel, there is a significant and persistent gap between the market curve, shows the blue lines, and the median expectation of bank rate as reported in the Bank of England's market participant survey. Those are the green, it's the green lines. I highlight this market participant survey. It has been around as an internal source of assessing market conditions. It is now available as a public source on the bank's website. And you can see that there's a gap between these two different measures of market assessment of the bank rate path going forward. When asked about this gap, respondents say that a large part is associated with expectations of how international factors might influence UK monetary policy. In addition to which, of course, there are UK-specific drivers and market liquidity challenges. So both this Rigabon decomposition and this survey gap assessment are reflections of the market's view based on historical experience. In other words, the market's view of the shocks as well as of the MPC's reaction function. So I'd like to move now to talk about, make an effort to quantify monetary policy spillovers using historical data. Now, it's well documented that the global factor is disproportionately associated with US macroeconomic and financial conditions. This, of course, is due to the sheer size of the US economy, the outsized role of the dollar, and through these channels, the importance of Federal Reserve policy. Therefore, in this speech on spillovers, I'm going to focus on the effect of US monetary policy on macroeconomic and financial conditions in the UK. We're going to look at the likely effect of a US tightening on the UK macroeconomy and to consider alternative policy paths that UK monetary policymakers might consider in reaction. Now, I alluded in the beginning of my remarks to what we know about the relationship between monetary tightening in any economy and the domestic economy. So while the domestic effects of a monetary policy tightening are pretty well established, the net effect on economies abroad is a priori ambiguous. On the one hand, via slowing US domestic demand, US monetary policy tightening would reduce demand for goods and services produced abroad. The global demand channel that I've just described causes a slowdown in activity and disinflation in other economies. On the other hand, all things being equal, a monetary policy tightening in the United States ought to appreciate the dollar vis-a-vis foreign currencies as compensation for holding dollar-denominated assets rises and capital flows to the US increases. For the foreign economy, this means capital outflows or reduced capital inflows and a depreciating currency. Now, as imported goods become more expensive in terms of the foreign currency, this global financial channel will tend to have an inflationary effect in the non-US economy. Now, this depreciation could make exports from this country more attractive on the world market, and there may be a boost to exports that could offset the global demand slowdown. And there's research on that. In sum, the global demand channel should induce the same size signs in output and inflation at home and abroad, slowing activity, disinflation, while the global financial channel would induce the opposite sign in the foreign economy, increasing activity and inflation. Therefore, the net effect for the non-US economy is not determined a priori. Of course, additionally, all things are not usually equal in the real world. And instead, which way activity and inflation break in the foreign economy depends crucially on the reaction of monetary policy in that economy. So what I'd like to do now is get a sense of what we know about the relationship between US and UK analysis using the data that we have for the US and the UK. The first stage identifies the effect of monetary tightening on US variables and their spillovers to the UK. So we're going to try to get a notion of what that sign is, the ambiguous sign. What is it for the UK? So if we turn now to chart 5, we're going to start looking at what we know about this from historical data. My colleague Leonard Brandt and I estimate a structural vector autoregression, including both US and UK variables, as identified by an external instrument for US policy. And there are really long footnotes in the speech that outline these in more detail. And Leonard can answer questions on if we're going to go that deep into the weeds. But what we look at when we do this, and this is state-of-the-art econometrics, I will say that, based on work by my colleagues in the research department at the Bank of England, also referenced, of course, in the speech footnotes and bibliography. Looking at this chart, in terms of the domestic response, that of US variables to US tightening, that's the red in these charts, the model yields plausible results in line with the literature for both signs and magnitudes. The red lines show that a shock which increases the US 3-month Treasury bill rate by 100 basis points decreases the level of real economic activity by 3% by the end of the second year. It also decreases the price level by about 0.4% by the end of year 3, although this effect is statistically insignificant in the sample, and if we want to discuss that, we can. For the UK, using historical data, it turns out that the US tightening has been inflationary rather than disinflationary. Even though output in the UK falls by nearly as much as the US, that's the blue line, the price level initially jumps and is persistently higher throughout. That's the blue line in the right panel. And it adds about a 0.5 percentage point to inflation by the end of the first year. This inflationary effect is consistent with the effect on the bilateral exchange rate, where here the US tightening that we posit as 100 basis points leads to a sterling depreciation of 4.5% by year 2. Importantly, Because these use historical data, these reactions are conditional on a database estimate of the reaction of UK monetary policy in the model. On average, over the past, UK short-term rates rise immediately after the shock, again, the positive shock of 100 basis points in the US, and the UK short-term rates rise immediately after this shock by 27 basis points, or about 1/4 of the US response. But they fall immediately thereafter, reaching a trough of -74 basis points at the end of year 3. Thus, on net, the UK policymaker in the model, as estimated from the data, chooses to add stimulus as a result of US tightening in order to offset the negative output effects of the global demand channel at the cost of temporarily higher inflation and a persistently higher price level. The rates differential between the US and the UK remains in favor of the US throughout, and this differential is the deciding factor for the financial channel, which is why the bilateral exchange rate traces out a persistent depreciation of the sterling as a result of the shock. To stabilize prices and alleviate the inflationary pressure coming through the exchange rate, UK policymakers would need to roughly go along with the tightening from the US. Of course, by doing so, they would exacerbate the fall in output. The MPC reaction function based on the historical data does not do this. So to conclude this section, past monetary policy spillovers from the US, as seen through the lens of this model and the historical data, have been trade-off inducing shocks for the UK: higher inflation, lower output. A Fed tightening depresses output both at home and abroad, but in fact puts upward pressure on UK prices through the global financial channel. Now, of course, it's important to note this is just one model over one time period, which I've taken to illustrate the issue facing me as a monetary policymaker. It's not necessarily the view of other MPC members, and these calculations are not the mechanisms and the multipliers used in the bank's forecasting process. However, I will note that the ready reckoners that we use have the same inflation output trade-off outcome. So now I'm going to move on to talk about scenarios for the UK monetary policy reaction that differs from the historical one that I've just been showing you. So models like this one only reflect some average response of policy and macroeconomic variables to an unanticipated shock. They need not reflect the reaction of the variables exactly at this moment. And in fact, I've written a speech, my last one, that suggests that the experience of the past 2 years should remind us that historical regularities may not hold forever. Most importantly, the way these spillovers actually manifest in UK variables of inflation activity depends critically on the actual reaction of the MPC. In other words, I still have a job to do. While UK monetary policy is endogenous from the perspective of a model, in reality, it's independent. There's no mechanism forcing the current MPC to act in accordance with its historical behavior. So going back to the challenge presented by the global factor in this tightening cycle, roughly speaking, the domestic policymaker faces two choices: either to try and stabilize economic output at the cost of higher inflation, or to offset the higher inflationary impact at the cost of higher output losses. To assess alternatives for how UK monetary policy could react to the given Fed shock and how these alternatives might change macroeconomic outcomes, I will go through a couple of very stylized scenarios. They are all predicated on the same US monetary policy shock that I showed you above, a shock that raises short-term interest rates in the US by 100 basis points. They differ, however, by the way that the UK policymaker chooses to bring onshore the external shock. So let's move on to what these scenarios look like, which is on the next chart. On the left-hand side, the chart shows the different paths for UK short-term rates. All the scenarios are set up such that the rate is constrained to certain values for a period of time, after which it's allowed to again freely adjust. These scenarios are very stylized and extreme examples of possible policy paths. They don't represent the MPC's policy intentions. They illustrate the sensitivity of macroeconomic conditions to the size and timing of UK monetary policy reaction to a US policy tightening. As a benchmark, the blue solid line shows the reaction as implied by the historical experience estimated in the spillovers model that I just talked about from the previous section. In this case, the UK policymaker raises interest rates by about a 1/4 percentage point for a brief period, but quickly reverses rates. The two other scenarios that are considered. One scenario, which is the blue dashed line, raises the policy rate by 25 basis points per quarter to gradually match the hike in the Fed policy rate, and then holds rates steady for a year. This path stands for a policymaker who opts for a wait and see approach and who is reluctant to put policy into reverse after they have begun tightening. The second scenario, which is the red dashed line, shows an activist policy path in which UK short-term interest rates rise by exactly as much as the Fed and are held at that level for 1 year before reversing. Now, the right-hand side then shows what these different rate paths imply for the value of sterling, which is a key part of the transmission of the global factor. Using the reaction function estimated from historical data, that's again is the blue line, the solid blue line, sterling depreciates almost right away, as consistent with the assumed interest rate differential. In the other two scenarios, however, sterling remains stronger for the first year. And in the activist scenario, which is the red, it even appreciates markedly shortly after policy rates are raised. It does depreciate by further down the line, which is consistent with the steep fall in policy rates that are necessary to return the economy to equilibrium after the Fed shock. In the activist scenario, sterling is more volatile. It counters the inflation in the near term, depreciating over the medium term as demand starts to slow down. Now we're going to show what these rates and transmission of exchange, the interest rates and then transmission to exchange rate, what this reflects for UK macroeconomic outcomes. So moving to the next chart shows us what these look like. A look at UK macroeconomic outlines underlines why these profiles for the policy rate and currency make sense. We have the reaction of UK activity on the left and consumer prices on the right, corresponding to the paths that I showed you before. The solid blue lines are the same as the ones in the chart 5 that you saw there, because these are the ones based on the reaction function of the UK policymaker and the endogenous macroeconomic response as estimated from the historical data. When we layer on top of the effects of the alternative path for UK monetary policy, we'll see two things. The MPC could choose to offset the inflationary impact of US tightening. That's the red. Matching the size of the US tightening stabilizes the price level as far out as year 2. As expected, however, this comes at the cost of a fall in output beyond which is implied by the historical data in the spillovers model, which of course didn't have as much of a rate rise or exchange rate appreciation. From the third year onward, the level of UK output is below the endogenous benchmark. But second, we can also see why it is important to react in a timely manner to a US monetary policy shock that causes the UK price level to jump on impact. Reacting with the gradual increases, which is the blue dashed line, and more importantly, delaying the policy reversal leads to higher costs in output in the second year and an inflation undershoot as policy is assumed to be constrained for a longer time. Although we can also do this exercise with holding the holding period for 6 months, and we get not too different an outcome. Now, in contrast, immediately reacting to the jump on the red dashed line and holding it to cement the inflation deceleration and then reversing in order to moderate the deterioration in outcome comes at little additional inflationary cost. So in considering the alternative paths, policy needs to be responsive to the economic context as well as to be nimble. If near-term inflation is the dominant concern, then the activist path addresses that. If medium-term output losses are the concern, then policy needs to reverse promptly. So to wrap this up, this section, let me stress again that these interest rate paths shown here are not predictions and they are not promises of what the MPC might or should do in the real world. They serve to illustrate the nature of the trade-off that the MPC faces. So taking this model, and I want to put it into the current context to finish. The scenarios outlined here are extremely stylized. Nevertheless, in the current environment of the inflation output trade-off and global monetary tightening, they help inform my policy decision. First, with regard to characterizing the inflation trade-off that we actually observe in the data for the UK right now, incoming data by some accounts suggest an increasingly stark trade-off in terms of rising and persistent inflation versus deteriorating real income. However, there are important nuances to judging these data, and I talked about these things in my last two speeches, and I will review those again here because I think that they are important ingredients to thinking about the layering on of the global factor. So to me, the incoming data on inflation show increasingly domestic embeddedness, persistence, and momentum. 90% of CPI categories are rising at rates greater than 2012 to 2019, and the distribution of expected inflation outcomes has shifted rightward and with a fatter right tail. And if you want to know why I look at the fatter right tail, you can read my last speech. On the other hand, even though higher energy and food prices, as well as overall inflation, clearly are hitting real incomes. In my view, there are countervailing factors importantly and increasingly likely to support consumption spending in the near term. These include the two fiscal packages, strong employment, widespread bonuses, as well as robust wage growth, strong housing values, accumulated savings, quality trade down, and borrowing through credit cards, among other schemes. All told, to the extent that consumption growth remains stronger than expected based on real income, this would support firms' pricing expectations and decisions, which adds to domestic upside risks to inflation. Taking my judgment that the domestic conjunctural situation is characterized by very high inflation and various supports to consumer purchasing power relative to real income, I now turn to the global factor. If the Fed tightens at the currently expected pace and the ECB musters an increase soon, the scenarios outlined above suggest additional depreciations pressure on sterling that could add to inflation, particularly in the near term. Using the reaction function based on historical data with about a quarter response to the positive Fed tightening would add about a 0.5 percentage point to inflation in the first year. While the MPC aims to stabilize inflation at the 2% target in the medium term, given the likely double-digit inflation, being mindful of the near-term implications of the global factor for inflation is particularly relevant. I voted for a 50 basis points increase at the last MPC meeting. In my view, a more robust policy move based on both domestic conjuncture and commensurate with the global factor would reduce the risk that domestic inflation already embedded would be further boosted by inflation imported via sterling depreciation. I will open the door to a policy rate reversal in the medium term when the domestic supports to demand fade and when weakness in external sources of demand bite. In my view, this monetary policy path supports an inflation output combination that is superior to that of the historical reaction. Thank you very much for the opportunity to give you my view on both the domestic conjuncture as well as the global factor, and I welcome your questions and our discussion.
Catherine, thank you very much for that fascinating presentation. If I could invite Leonard to, thank you, Leonard. Fascinating presentation, which appears to present the case for a more activist monetary policy approach than currently adopted by the MPC. Already a lot of people lining up to come in with questions, so I will move straight to it. But in doing so, remind our panelists, please also share your thoughts on where you view the various reactions of central banks to the inflation challenge at the moment and the Bank of England's position within that. Filippo Cartiglia first. Filippo.
Thank you, Kevin. And thank you very much, Catherine Mann, for this very interesting, insightful, and brave presentation, especially the analysis of past behavior of the bank shows us that how we should interpret the commitment that the MPC says that the inflation target applies at all times, reflecting the primacy of price stability in the UK monetary policy framework. This already gives us some information on how much we should believe in that commitment. And also, so I was reading the minutes of the meeting, and I actually, the question I have refers to the outcome of the last meeting. In the last meeting, some market participants noted that one statement at the very end of the one sentence at the end of the statement was omitted. Last time, the minutes said that most members of the committee judge that some degree of further tightening in monetary policy may still be appropriate in the coming months. Now, this sentence no longer appeared in last week. Now, I suppose, as you explained to us, you probably think that that sentence would still be appropriate because you wanted 50 basis points last time. So I suppose, and correct me if I'm wrong, that you would think that more will be needed. But so the question is, why is that sentence not there anymore? We have been scratching our head. I mean, at least personally, I have been scratching my head in trying to understand what's the meaning of that omission. And maybe you can explain to us. Thank you.
Close readers, it's always a good thing to have close readers of the minutes. That sentence was wearing thin in terms of our view on what it was communicating to markets. And we have market intelligence. That's part of the internal workings of the bank, has a lot of market intelligence where they talk to market participants about what they think that we are communicating to them. And in some sense, that sentence had changed nature over the past few sessions, few meetings. And we thought it was appropriate to recalibrate market thinking about our prospects for rates going forward. And so we didn't leave out, we left out that, to change that sentence. It's not that we didn't give any guidance. We actually gave important guidance about the size, timing, and pace of any future rate rises. That was a replacement phrase that indicated, as you know from the votes, that there were differences in views on size, timing, and pace. And so that is still true. But it also, that section incorporated an important assessment about being vigilant about persistence in inflation, to be looking carefully about persistence in inflation, as well as to react forcefully if in fact such persistence became more apparent. So we did change the language from what you had read before over several different meetings, but in some sense we replaced it with language that I think gives you more information about what exactly it is we're looking for in the data going forward for and how we will react in order to meet our commitment to the 2% objective in the medium term.
Filippo, does that clarify the omission?
Well, thank you for the answer. With respect, I'm not sure I understand why it was wearing thin, in the sense that this sounded like an ongoing forward guidance saying, well, this is what we think is most likely to happen over the next meetings. Not a promise, but an assessment. When I read what you replaced it with, frankly, I am not sure I get a sense of what comes next. What is your best judgment of what comes next? Because the scale could be 0. And it says it would be forceful if necessary. But who decides if it is necessary? What are the characteristics? So to me, it doesn't, frankly, reading the replacement doesn't tell me whether a further move is more or less likely next time. But maybe other people have a different interpretation. So this is just my own take.
One thing that I think you have to remember from the previous previous meeting was that there was not a forward guidance that everyone agreed to, and so and we think it is important as a committee to have a communication. I mean, we each have our own vote. That's the way the Bank of England works. We have our own vote, and we have our own speeches, and we give you ideas about where we think, what we think is important in our assessments, and what it is we think we might take in terms of policy action against the data that we observe and we assess. But it's also very important, and this is something that I said at my TSC hearing when I joined the Bank of England back in last September. I think it is also important for there to be a committee view that is projected to not just financial markets, but also to real, people out there in the real world who are making decisions about consumption, buying a house, or doing business investment. And so having a common view is an important thing. What this guidance tells you is that there are differences in views among committee members. Yes, you should know that, if that's already obvious. But it's also telling you some what it is that we think is an important data. We're data-driven. I said that in the speech. Everybody is data-driven. What data are we looking at that we think is particularly important in making an assessment? And that is persistence.
Okay.
That is the important ingredient, persistance.
Thank you, Filippo. I'm going to move to somebody who's no stranger to the MPC, Jan Vliega. Jan, would you like to come in?
Thank you. Hi, Kathy. Hi, Leonard. I have two questions. One is a slightly more academic challenge, and the other one is more directly policy related. So you say that your results are quantitatively and qualitatively in line with what other people find. I'm going to push back quite a bit on that, because the US output response is something like 6 to 10 times larger than what most other people find. And the US inflation response is, relative to that output response, is tiny, implies almost no Phillips curve relationship at all. And so since that's so far out of line with what other people find, I'm just wondering how much weight you want to put on those results, and on the idea that what you've identified is really a US monetary policy shock. One other model result which kind of puzzled me is that you explained very nicely the intuition that if there's a US monetary policy shock, then in the UK, you get a depreciation, and so that causes inflation. But your inflation is instant and your depreciation is very lagged. So there must be something else going on, and I'm not sure I follow. My policy and policy communication question is, lots of central banks in the last few months have found it useful to communicate their, at least conceptually, without being overly precise on the numbers, to communicate their policy thinking in terms of a neutral rate, and then where we want to be relative to that neutral rate. So, the Fed and the Bank of Canada have said, look, the constellation of the economy is such that we probably want to go a little bit above neutral, slightly restrictive. Other central banks, like the Australians and the ECB, have said, well, we probably want to get closer to neutral, but we're not sure yet. We want to go above it. And I'm just wondering why the MPC hasn't found it useful or necessary to communicate in those terms, and just to leave it completely open, which is a very different way of communicating from everyone else. Thank you.
So on the academic question about the findings in this particular model exercise, well, the flat Phillips curve is sort of an observation that we've been struggling with for some time. Now, I think there's some question about whether or not now we are in an environment where there's a upward sloping Phillips curve of the normal type, but certainly in a very long period of time in historical data, we've had a flat Phillips curve. Also, I will, I can turn it over to Lennart if he wants to give you chapter and verse of the macroeconomic handbook article written by Valerie Ramey on the size of the multipliers. That this, in fact, the ones that we have are within the range of those in that macroeconomic handbook article. The depreciation and instantaneous inflation, I'm not sure, I didn't quite hear which one of those you thought was too fast versus too slow.
It's just relative to each other. Like, if the depreciation is what causes the inflation, then how can the inflation appear before the depreciation has happened?
Expectations, right? There you go. If you think about a model of inflation, and I've outlined this model of inflation in, I think, both of my previous speeches, more in detail, I think, in the most recent one, the last one. Inflation is a function of inflation expectations, prices in commodity markets, and tightness in labor and product markets. So inflation expectations play a very important role in the inflation process. And so that's how you can get the timing that we have. Your policy question on that, your argument or your assessment that other central banks have given more explicit guidance that there is likely to be policy reversal over some time period. I think that's basically what you're saying, that if you say that you're going to tighten greater, that your policy path is going to peak above the neutral rate, then that's basically what that says. It's true that we have not given you that path. On the other hand, it is the case that the market path is the one that is embodied in our forecast. That is our standard approach to our forecasting exercise. And you saw on the chart that I presented that there is indeed a policy reversal, according to the market participants.
Okay, Jan, do you want to come back, or are you?
I mean, that's just saying that the market thinks that you're going to reverse. That doesn't tell people anything about what you think collectively. That's kind of the point. Whereas other central banks are saying, no, this is what we think we're going to do. But I mean, I understand you don't find that useful, apparently, to communicate in those ways.
Well, that is, we don't give you we're not like other banks where we internally have well, we have our forecast. We predicate the forecast on the market path. We're also showing you, in a sense, the market path and also our market participant survey. You can also derive from the individual votes from the members what their views are. And it is the sort of the democracy of one person, one vote that will ultimately outline the policy path going forward. I gave you pretty clear indication of what I thought needed to happen. And in last speech, I also talked about the difficulties and uncertainties associated with putting a specific number on the long-term rate or the settlement rate or the neutral rate for R-star. There's a lot of uncertainty about that.
Okay, thank you. Leonard, you put your hand up. Was that in relation to Jan's questions? Or
exactly. I just wanted to give.
Yeah, please come in.
I just wanted to give some more details, sort of on the academic question.
Yeah, sure.
So first of all, I agree the output number is punchy, but when you look at this Ramey article that we cite, where she collects all of these results on different identification of US monetary policy shocks on US variables, we see that it's well within the range. So there are basically the entire range from 0 to 5% is spanned, and papers that use this external identification scheme that we're using do tend to find somewhat higher effects. So I wouldn't be surprised that we're at the higher end there. And similarly, which is also in line with the literature, is this fact that the CPI response in the Great Moderation period is hard to discern. And it's not that we find no response, right? There is 0.4 in the median response, sort of, but the uncertainty is just very wide. And yeah, you have to in these models, you have to fight quite hard to get a classical sort of inflation response, and you can get it if you, for example, restrict the model. If you say, okay, give me only those that imply a negative sign. But here we've been very agnostic. This is really we impose no structure on those shocks. This is just what the data tells us. So I think we're fine on that. You might still disagree, of course, but we found it plausible that we got those results. On the UK response, then, it's true that there is a bit of a disconnect in sterling and CPI, but these are predicated, the results are predicated on this historical response of UK monetary policy, which works to offset some of the sterling impact endogenously. So if we can impose, and in the scenarios, we've imposed paths that take sterling even higher, whereas we might impose a path with policy does nothing for the first couple of months, or even cuts in anticipation of the output slowdown. So, and these were all then changed the responsive, so the path for sterling. So I think this is the important lesson here, that UK monetary policy is deciding how to bring onshore the shock, as Catherine said in the speech. Hope this helps, but happy to discuss further.
Okay, Leonard, thank you very much. Meantime, I'm going to move on to, and Jan, thank you, and move on to Alan Clark. Alan.
Hi, thanks, Kevin, and thanks, Catherine, for your speech. So I wanted to ask about process. If I understand correctly, you take the decision on the Wednesday, announced on the Thursday, and the big discussion meeting is the previous Friday. Now, in between times, there was speculation built of the Fed hiking by 75 BP. Given the content of your speech, that would have probably swayed you towards your 50 basis point vote. But also we had some disappointing GDP and labour market data. I just wanted to know, given your big meeting on the Friday, how seriously do you and should we be taking those last minute data prints and speculation of what the Fed or ECB might be doing? And also, if I may, in the minutes, it talks about the three dissenters putting higher weight on the prospect of more resilience in demand or shortfalls of supply or both. Given the content of your speech, again, if we were to see some more softening in GDP in the coming months, actually, and the Fed keeping on hiking by 75s or 50s, does that dilute the dovishness of disappointing domestic data?
You've got a couple of different things in there. Friday is an important meeting, although it's actually, even before Friday, we have a lot of discussions about data and so forth. And then we ultimately make a final decision on the Wednesday prior to the announcement on Thursday. There was a fair amount of information that came in that time period. Friday, and my view, however, is on the data that came in with regard to GDP and employment, parsing through that, the accounting for some of the test and trace, Jubilee, gives a negative cast to what I believe is a stronger prospects for consumption going forward. I outlined a number of reasons why I thought consumption would be more resilient, even in the face of what is a very significant shock to real income. I am not saying that real income is not being harmed. I'm saying that real income is being harmed by the energy and food price increases, by the overall inflation increases. There's no doubt that the purchasing power of individuals has been severely eroded, and some more than others, of course. However, when we think about the various schemes put into place, the fiscal packages, there are now two of them. They represent a significant improvement in offsetting some of the energy prices, price shocks in particular, for a range of the population. They are big in terms of offsetting the shock to real income coming through the energy channel. There is also outlined in the household surveys that many people are going to be drawing down their accumulated savings as a way to increase to stabilize their consumption pattern. There are people who are planning to consume more than would normally be the case out of their paycheck. So marginal propensity to consume. We think that the bonus, or at least I think that the bonuses are a very important uplift to the capacity of consumers to maintain their consumption patterns. Quality trade down. Many people would view that as not something that they would want to do. They don't want to trade down in the quality of the products that they buy, but it does represent consumption. It's a different set of firms, it's a different set of products, but it is still consumption. And so an additional borrowing, which is of course a vulnerability in the longer term. So this is this gap between the capacity to consume against the real income deterioration. This is something that gives firms more pricing power in the near term. And this, I think, is a very important piece of the current puzzle that we are looking at in the UK economy. And that this is an important part of the domestic conjuncture against which we then have to add this issue about the global factor. So your comment that the other foreign central banks, that in particular pathway of more than 75, the point about that I mean, even at 50, even if the Fed had done 50 instead of 75, the exercises that I've shown here, the stylized exercises, would still be valid. And of course, we also have to acknowledge that the sort of the direction of travel for the Fed relative to the Bank of England had already been incorporated into some sterling depreciation already. So these exercises are assuming unanticipated, they're very, very stylized. If we pull back and look at the real world data, we already know that the global factor has been an important underpinning of the market curve for the UK, and that embodies some of the rate differentials that they could see coming down the path based on the historical reaction function of the Bank of England and their expectations for what the Fed was going to be doing.
Thank you, Catherine. Alan, do you want to pop back in, or are you content there?
That's all very clear. Thank you very much.
Thank you, Alan. I'm going to move to Chris Crow. Chris.
Thanks, Kevin, and thanks, Catherine, for this excellent presentation. I thought it was really fascinating, and I look forward to delving in more detail into the model and trying to understand it. I had a couple of questions. One kind of more kind of relating to the model, and then maybe a more policy-related one, if that's okay. The kind of more kind of geeky question was on, you sort of eyeball, the data on US interest rates and UK and other advanced economy interest rates. It looks like the hiking cycles are fairly well correlated. When the Fed hikes, generally speaking, other central banks hike as well. But in the model, which obviously is looking at shocks, which is slightly different from looking at just the overall path of rates, but looking at shocks, it sort of looks, if I understand your model correctly, that the typical historical UK policy response has been to lower interest rates in response to a UK hiking shock. So is that model result consistent with like I say, what looks like the historical norm, that rates are kind of positively correlated across countries? So maybe how can we understand that? And then the question I had, which in a sense is probably you're probably the wrong person to ask this question to, in the sense that you and your two other colleagues who voted for 50 basis point hikes are probably more on side with the question than the other members of the committee. So in a sense, I'm probably asking the wrong person. But when you look at, as you say, this sort of broadening out of inflationary pressures, a number I look at is sort of median inflation in services, looking at the near-term trend in that over the last, say, on a three-month annualized basis. That's really just trending ever higher in the UK. I think it's running about 3.5% on a three-month basis at the moment. And I sort of struggle a little bit to understand why the bank's not being more aggressive in terms of its hiking cycle. When you look at the broad range of inflationary pressures in the UK economy, it just seems odd to be so sort of timid in terms of hiking rates. And the fact that other central banks globally seem to be moving in a more aggressive path just sort of highlights that. So I just wonder if you could give us some insights into, from the discussions you've had on the MPC as to what you think is driving that sort of resistance or reluctance to be a little bit more aggressive on the hiking side.
Okay, thank you for the question. Let me take that last one first, because it sort of follows on from the answer that I gave to the previous question, I think there is an important differences of views on the committee on the degree to which there is resilience in domestic consumption in the current environment. I think that's, obviously I'm not going to speak for other committee members. They have the opportunity to talk to you directly, or via speeches. But there is, I think this is a very important part of where we think about the economy, broadly speaking, using very, very similar models. But we do assess the data somewhat differently. And as a result, there is, for some people, more of a weight on the potential going forward for significant deterioration in demand. Now, if you have significant deterioration in demand, then that disciplines firms' pricing. In other words, if people aren't showing up at your store, you got to reduce your prices, put in discounts, whatever. And that is, I think, a very important question for what the dynamics of inflation in the near and medium term might be. My view is that in the near term, there are these supports to consumption and to purchasing power that creates a wedge or a gap between the deterioration in real income and yet the potential to continue to consume for some time. This does not mean that the gap stays there forever. I see potentially in 2023 that gap closing, and that's the time when I would think about changing my direction. It depends on many other factors too, of course. But so I think that's these are the kind of data that become very important in our assessment. Labor market tightness, again, very important ingredient. How tight will it continue to remain? Will inactive, a very large proportion, this is a key puzzling. It's a puzzle in the UK, it's a puzzle in other countries as well. Getting inactive back on side, back to work. What are the challenges there? What dynamics do we see? Because of course that plays into prospects for the labor market going forward. On the technical question about the hiking cycle and the historically consistent. So let me just, before handing it over to Leonard, if he wants to add some more on this topic, we have to remember that there hasn't been a hiking cycle for a very long time. And so when we think about the historical experience on UK data is that the UK policymaker doesn't follow the global hiking cycle in the historical observation. And then if in our model, we're positing a hiking that does follow, but different paths, either a jump path or a gradual path. What you're looking at when you look at the market curves, where you're making the observation that looks like all of them are kind of following each other up. This is a new phenomenon, right? This is a new phenomenon. We haven't looked at curves like this for quite some time after the global financial crisis. So that what we're looking at now is Marcus' new assessment of what they think might be the strategy going forward. Leonard?
Yeah, I was just going to add, in the model, there is actually some correlation between the reaction of the Fed shock and the reaction of UK monetary policy, because in the you saw on the slides, the endogenous reaction of monetary policy in the UK is also to raise rates to a US monetary policy shock, just not by as much, and then reverse quickly. So and this is, of course, an average of a historical reaction while we sort of impose the 100 basis points for the US. But this will lead in the data to some co-movement between the two. And another, just one last point, the US curve, which we haven't shown you in the slides, the US yields also fall after they initially hike. So there is a endogenous return of policy to the steady state, if that makes sense, in both countries.
Okay, thank you, Leonard. Chris, are you content?
Yes, thanks. No, it's very interesting. I'll take a look in more detail at this. It's good.
Excellent, thank you. David Robinson. David.
Thank you very much, Kevin, and thank you very much, Kathy. Just going from some feedback we've already had from the external world, how much do you worry that the takeaway from this speech is going to be raise rates to defend sterling, defend the pound? Because that has firstly slightly unfortunate historical connections, and secondly raises the problem, if you do raise rates and other factors, and interest rate differentials aren't the only factor on the pound, intervene and push sterling lower for some reason, how's it going to look then? How are you going to communicate the message?
Yes, I have used that historical experience in many a classroom example. So there's some just great footage that one can use in a classroom setting. And of course, I was a professor at Brandeis for about 10 years. So we are not, I mean, this, I don't see this as defending sterling. It's, that's not, in fact, that's not what we're doing. Sterling, as you compare these different scenarios, sterling is more volatile under the more activist scenario. And if I was going to be, if I thought that my objective was to defend sterling, then presumably the volatility of that would be inconsistent with the word defend. Sterling illustrates the transmission. It's not the only transmission. It's, you know, currencies are the sum total of many of the factors, real side factors, financial factors, confidence factors, uncertainty. So currencies are always a summary statistic of much more fundamental determinants of the behavior of economies, both the financial side as well as the real side. So I think from those two kind of angles, I don't see this as being in that one would infer from what I'm doing here in this model as somehow a defense of the sterling.
Okay, thank you. We've got several people still wanting to come in, Catherine, and time not entirely on our side. I'm going to bring you in, but ask, please help Catherine out, and maybe just give a sense of how you feel the Bank of England is doing at this conjuncture. Adrian Paul first. Adrian.
Thanks, Kevin. Two maybe briefly related questions, kind of on how we should think about the evolution of your vote between May and June, and the evolution of the committee between May and June. So it seems like on the May to June on your own vote, if you were to think about like the kind of global versus local factor in your vote for 50 in May, presumably the domestic factor exacerbated and the global factor exacerbated when you decided in June. So in that context, how to think about how you assess the marginal information between those two meetings and why that kept you at 50. Related question, I think what you said about the committee was very interesting. So should we think that, I mean, I interpreted the guidance as signaling that the variance across MPC members had fallen between May and June. It seems as though would it be one interpretation of what you said is that the variance of committee members' views across the committee has increased between May and June? So just to get your sense of that, please. Thank you very much.
So with regard to sort of the marginal information between May and June relevant for me, I think I've sort of talked about the extent to which the data that I've looked at increasingly concerned about the persistence, the embeddedness of second round effects in the domestic inflation. I've talked about expectations in a number of different speeches. That's something that I see continuing to be importantly creating uplift, upside risk to inflation. And I think on the table before, but also now, because before the Fed was discussing more aggressive moves, ended up being more aggressive. And so the global factor becomes increasingly relevant. Now, you could see from the Rigabon decomposition that the global factor has already been important for me. That decomposition is one of those charts that we get to look at regularly. So the global factor shows up in today's speech. It was fortuitous that this speech is being delivered at a time when we do have these rate differentials being more prominent. But that was the luck of the timing of the speech, as opposed to the marginal information that was provided between the May and June meetings. In terms of your second question, there is one guidance now that should tell you something.
Okay, Adrian, do you want to come back in briefly?
No, thank you for those response. I mean, personally, I'm not sure what. Okay, I mean, that's very, very useful comments. Thank you.
Okay, all right. Yeah. I'm going to go on to Ben Navarro. Ben.
Thanks, Kevin, and thank you very much for those comments, Catherine. Hugely insightful as always. I had two very quick questions. First, on the kind of potential deviation from the sort of average impulse response functions that you presented. I did first wonder whether you thought, given, and you referenced it in your speech, the very strong traded goods inflation that the UK has experienced, and clearly the role in which US domestic demand has played in driving some of that imported inflation. I wondered whether you thought that circumstance or that starting point, is there the potential to drive a slightly stronger sort of negative or medium-term disinflationary effect, potentially as a result of not just sort of dampening US domestic demand, but indeed driving a little bit of a normalization in the composition, particularly given that sort of goods story and difficulty that we've all been struggling with over the last 6 months. And the second question I had, and this follows very closely on from David's, was on the persistent inflation drivers that you referenced were clearly prominent in the minutes and otherwise, but there is an element of your comments here which strike me at least as potentially suggesting that while drivers of higher near-term inflation shouldn't necessarily drive monetary policy, given where we start, further upside risks and kind of some of the concerns around inflation expectations does mean that warrants particular focus. And I guess I was wondering, you made the point with respect to sterling, should we have the same read with respect to, say, further upside surprises on gas or energy prices going into the fourth quarter?
A lot of stuff there. I think one of the questions you were asking was, to what extent should we think about the slowdown in demand in the United States, taking some of the pressure off of global goods prices, and that percolating onto the UK to create some downside momentum in inflation, the imported inflation. So a couple, it is certainly true that that inflation at global prices is relevant for UK prices. No question about that at all. It's a very important ingredient in domestic inflation. But one of the things that we've noted in the data over the last 6 months or so is the extent to which the domestic components of inflation become more apparent. And in particular, UK goods price inflation is running about 4 percentage points above global goods price inflation. So that wedge has increased. And so that is telling us that even if there was to be a deceleration in global goods prices coming from slowing down in the United States, that there is a risk of decoupling that would keep UK prices, price inflation higher than we might expect based on kind of historical relationships between global goods prices and UK goods prices. So that's something that is a very important thing to be considering. On the upside risk to near-term inflation and sort of paying attention to near-term inflation, even though our remit is for medium-term inflation, the 2% objective. I think the point here is that there is work done by Ricardo Reis, who is one of the academic, he comes and gives academic advice, very well known. There is work that he has done that shows that when you have high inflation and then you have another shock which hits inflation, that you could jump to a higher permanently or persistently higher inflation rate. And those kinds of jumps are something that I think is something to be very concerned about, and puts a premium on paying attention to near-term inflation, because endogeneity between near-term inflation and medium-term inflation could be higher now than at some other time. And a third dimension that also creates an endogeneity between near-term inflation and medium-term inflation is, of course, inflation expectations. And the extent to which inflation expectations are informed by the salient items that individuals buy. This is where the energy energy and food comes in, but also inflation expectations are in financial markets are also near-term financial inflation expectations. And for both of those reasons, all three of those reasons, the jump, the salience, and the financial markets, I think that we have to worry about near-term inflation endogenously creating upside potential momentum for the medium-term inflation and moving us away from objectives. So that's why I focus on that. You had something to say. You had some question about impulse response functions, which that was your first part of your multiple choice questions. So I'm not sure, Leonard, did you follow that one? I'm not sure I followed that one.
Yeah. If you could
yeah.
repeat that question.
Yeah.
Sorry, Ben.
Yeah.
No, I think that answers perfectly actually on the trade. It was a function of the traded goods piece. So that's great. Thank you.
Yep, and Ben, thank you. Our last questioner, I think, is Ian Amstad, please.
Yeah, thanks, Kevin, and thank you, Catherine. That was a really interesting speech. So we've had an ever-rising path of market interest rates and ever-declining inflation at the end of the forecast horizon in the successive monetary policy reports of February to May. That looks like a major disconnect. You know, what can we infer from this? Is this prima facie sort of kind of evidence that the bank's estimate of neutral is a lot lower than the market path, or lower than it was last published, I think in 2018, when I think it was estimated at around 2 to 2.5? Or does this mean that the model is perhaps wrong, or sort of over calibrating you know, data from the pre-COVID regime, you know, the low inflation flat Phillips curve regime? A second question, if I've got time, was similar to Adrian's. What was more important information specifically and incrementally? Was it you know, the US data that we had, Michigan and CPI, allied to the ECB becoming more hawkish, or was it domestic criteria and the fiscal package? How much of that? How much is that a sort of a game changer for you? The package announced on the 27th of May. Thanks.
Mm-hmm. So just taking that last one, as I say, going into for me, the new information was obviously always take on board new information. But for me, the information going into the meeting, going into Friday, was already the important important information that I needed to make my assessment. And again, it goes to this gap between real income and consumption potential most of the data on that was already in our pockets. The fiscal package was an additional piece of that that only served to add to, in my view, the potential for near-term consumption being more robust than perhaps based on a model that relates real income and consumption and assumes that they are really very tightly related. Sort of with regard to sort of the forecast that achieving medium-term objectives for the 2% target, I come back to reminding people that the forecast takes as the input to takes as the input the market rate path, and that is a key ingredient in driving the outcomes that you see, as well as a very important ingredient as well is the energy price assumption. Which is to keep the market curve for 6 months and then hold it steady. So these are really important ingredients, and we have gone through in various monetary policy reports. We have done scenarios on both rate path, with the constant rate path being an alternative, as well as several different scenarios on the gas and energies path, using the full futures path as an alternative scenario. These are very important to look at, these alternative scenarios, because it gives you an idea of just how sensitive the forecasts are to these two critical assumptions. And that's something that I think everybody should kind of go back to the MPR. And of course, we're going to have another round here coming in August with another monetary policy report. I'm not telling you what's in there yet. I don't think we actually know, but these are important, these two assumptions about the market rate path versus a constant rate path, and energy assumptions, full futures versus futures for 6 months and then a hold. These are very important ingredients in the overall paths for output and inflation.
Catherine, thank you. Ian, thank you. Our time is up, and I conclude, Catherine, by thanking you very much indeed. I feel you worn your academics hat at this session and set us all some pretty chunky homework. So we'll go away. You've certainly got plenty to think about. Indeed, I think there are more questions than answers at this point in terms of the path of monetary policy. But thank you very much for sharing those important thoughts with us. Thank your colleague Leonard too.
Yes.
And I thank our panelists for engaging with us today, and everybody who has listened in via the live stream to this MNI Connect video conference. Thank you all very much indeed. Thank you, Catherine. And I invite everybody now to please disconnect. Thank you.
Thank you. Bye-bye.
Bye-bye. Thank you.